Happy Wednesday, and thank you so much for attending another session of RM Smart Investing. In today's session, what I thought would be good to review some of the option strategies, and I put down in 30 minutes because we've done option classes in the past. We've looked at the different strategies, and one of the ones that I would definitely encourage you to go look back is I think it would be a good guidance for you is almost all the strategies are under one roof. What I will do is I'll send you the PDF of that along with the recording, so you can refer to that. What are those strategies, whether it's a butterfly or you're looking at like a earning strategies. So as always, I have my 7 rules for them. So today, what I want to do, I was just going to make it a little simpler. I'm not going to go over the strategies themselves because we do have so many videos for each one of them. What I want to do is basically focus on the 2 key ingredients that separates really options and makes them more attractive than, let's say, just investing in stocks or investing in commodities. And basically makes it more attractive in a sense that in a different markets, you can actually take advantage. So obviously you're familiar with the 5, that the Greeks, as they call it, from the options point of view. But the 2 most important in the valuation of options and the strategies that we use, they're the 2 most important ones are the theta and implied volatility, I would say. So, and that's where we build our strategies based on these. So if you get again, understanding how the theta works, then we can build, again, as I mentioned, our strategy around that. So in a nutshell, what is a theta? We call it the time decay, is the rate of decline of the value of an option. It's due to the time. So that's why it's called time decay. And we've used this before. As you know, the longer the option duration, the slower in the beginning, but then the faster the last 30 days. It starts actually on the 45th day. And you can see the main thing is the slope. And this is a strategy that we use because of this time decay. A lot of, again, option players, especially you've had many of these Robinhood, for instance, option players, they the novice ones, they come and they think it's almost, again, like gambling. They can just buy a call option and they make a lot of money. It is possible, but the probability is not that high because they could be right about the direction of the underlying asset, but they don't have a very good understanding of the components of the option, and this is the big one. So basically, again, the theta plays a big role when you're choosing your option strategy. Giving you one example, for instance, this is an XYZ company. It's at $50, and let's say we buy an at the money 50 call. The implied volatility is 40%, and assuming interest rate is at 2%. So you can see when it's at 150 days to expiration, the theta, the amount of option value that you lose per day is 1.8 cents, almost 2 cents. So option premium is at 530. As we get closer to the expiration, the velocity gradually starts going up. So, but not that much till, as you can see from the 60 to 30 day, all of a sudden we go from almost 3 cents to 4.5 cents. And day by day, it becomes more and more. So by the 5th day, the 5th day before expiration, almost out of the 94 cents of your premium, almost 9 to 10 cents goes to the time decay. And by the end, the last day, the whole premium is your time. So that's one thing. Again, you want to pay attention. You can see the velocity of reduction in the premium. And the other thing is, which as far as options we want to choose, whether we want to use at the money, in the money, and out of the money. Out of the money is purely premium. As you know, there's no intrinsic value. It's the at the money which has the highest velocity. So what you can see is if your assets underlying securities at the money, that's the one which loses the most. In the money will expire, obviously will have intrinsic value, so you still have some value in there, but at the money is the one which is all-time value by the end. The second part of the thing, as far as that I would emphasize that you want to build your strategy around, is the implied volatility. So the higher the volatility, the higher the premium. So the goal is, I put down buy low and sell high. You'd like to buy low implied volatility compared to its historical volatility, and it's at the low end. Like we talk about squeeze, for instance, you talk about losing Bollinger Bands, and you see it's in low volatilities. That's when we want to buy. And if we want to be a seller, we want to make sure we are in the higher quartile of the volatility of that security. We also basically implied volatility. We've been using this expected move. And what that means is 68%, 68.2% to be exact, of the time, the option market makers, they value the option based on saying that this probability of what is the one standard deviation probability of an asset to be between the two prices. And based on that, they build their probability of, again, reaching those. So as we go outside these, and we got 16%, 16%, the edge gets lower. And then when we go to two standard deviations, 95%. So implied volatility is really standard deviation around the price where it is. To go farther, if you have an option, the stock price, like today, you buy an at the money is like a 50-50. It's the probability. You don't know, there's a 50% chance it's going to go up, 50% chance it's going to go down. As you go further out, you go out of the money or in the money, your implied volatility actually increases. So that's another way of taking advantage of understanding implied volatility, that the higher, as far as the out of the money, or the more are in the money, the more you will pay for the implied volatility. And I will have an example for this. So how do we can use these? So basically, I'm just going to build my strategy around these two things. We have to remember there is no absolute, there's no independent because of the intrinsic value. What I'm trying to do is, the implied volatility plays a role, theta plays a role in all the strategies, but more importantly, as far as the biggest effect in that strategy, that's what I'm trying to use. So it's not exclusive of everything else. This is the biggest factor. So remember, with the theta, because remember what happens to the option premium, especially in the last 45 days, especially again last 30 days, it is going down. So it affects your option prices. So if you are a holder, right, if you have bought an option, that will affect you negatively, because as I showed you on the chart, it will go down. On the other hand, if you're on the other side of this trade and we're actually the seller, which is most of the time we call them the casino, you are the other side, that will positively affect you when you sell. So basically, again, one of the examples, I was talking to my son, I said, the way you can look at the options is when you have a car insurance and you're buying a put option. Basically, if you have a car insurance, you pay this premium, and we're talking about hedging. If you don't have an accident, you just pay that, and eventually, if you have it for 1 year, after 1 year, then you didn't have any accidents, then the company keeps the premium. And the same thing, this is the way that you can say, that if you're selling the option, you're keeping the premium. Now, if something happened, on the other hand, then they have to pay the the value of the car, for instance. So that's one of the ways. So the strategies that if you want to look at, again, the biggest factor when there's theta, you can take advantage of it, will be, I do not recommend selling naked calls. I'm not big on that, especially your risk could be unlimited. But covered calls could be an attractive way. You have the underlying asset. So that call, you're basically using, again, the time decay, you're collecting that premium. So that's one strategy as far as the theta goes, or the time decay. The second one is buying something at a discount. You have found a good value, and you think the stock is at a discount, so you wouldn't mind owning it. So you can go ahead and at a special discount, you can sell a naked put, basically sell a put, as long as you have the capital to cover it. So that's another way. So what you could do is it kind of becomes a win-win situation. If the stock doesn't go there to hit that, then you will collect the premium. If it does go down there, then if your option is exercised, then you bought your stock at a discount, and basically you even got a good premium for it. Combining these, you can do actually credit spread call. Rather than buying the pure call, you could do call credit spread. So it kind of reduces your basically capital obligation and your cost. So you're using almost like, again, like a covered call. You're basically covering your long call by selling the short call. The same thing with put credit spread. So in a sense, what I meant by that is you're basically insuring when you have a credit, you sell and then you insure yourselves to cover your risk. So basically you're limiting your risk by doing the call spread. And again, that's a theta decay. The same thing with put credit spread. Again, you're limiting as far as how much you could lose. And then the last but not least, which is very attractive, is we call that the horizontal, the calendar. Instead of being vertical, it's the same price. And you basically take advantage of, again, the time decay. You sell the near one, you buy the longer term one, and basically you can just keep rolling it and have like an income strategy with this. So these all depend on the time decay. So as I said, still we have the implied volatility. We talk about delta and all the probabilities, but the main, as I said, the main engine of this strategy is the theta. Then let's talk about implied volatility. As I mentioned, you want to buy the volatility if it's low, compared to the historical or quartile, and the way the markets are, and then try to sell it to collect, knowing that the premium has been exaggerated. It's outside what is enormous. So that's the whole strategy. So just for the pure implied volatility, you can just have something like a straddle. We talked about the squeeze, again, the low volatility bands, and something is coiling. Then there is going to be a move, but you have no idea which way. So that's a volatility play. And basically, you just, since you don't know which way it's going to go, you're going to buy call and the put, and then wait till that move happened. The thing is, though, you still will have the time decay. But again, underlying factor for this still is that implied volatility. That's what you're betting on. And then strangle is similar to straddle. It's just you have a zone rather than just a specific price. So these are the two you could do. You could also, if you want to go opposite, if something is, if there's a large band and the implied volatility is an extreme, you can actually sell straddle or strangle. So speaking of that, then what we could do, we could combine the theta and and implied volatility. And that's what generally most of the options will consist of. And for instance, you could have a debit call spread, you could have debit put spread. Again, in this situation, you're limiting your risk, but you could have also you could limit your as far as upside profit, but it's pretty known. So the difference between the debit call and debit put call spread and debit put spread and the credit is really your risk reward. You're taking a lot of risk and you're making little reward. So in this situation, you're taking less risk, but more reward. The whole thing is about the probability. When you do the credit spread, your probability is much higher than when you do the debit spread. So it's all about probabilities. So that's what the credit call spread becomes an income-oriented strategy. Now we just talked about straddle, strangle. We talked about all this, debit and credit. We can marry them, and then we have the butterfly spread, for instance. Or you could have iron butterfly. Butterfly, you only have the same underlying as far as either their calls or puts. Iron butterfly, when we put iron in there, that means they have put and call. So you're marrying again credit call spread and debit put spread, or you have the straddle and you're selling the wing. So basically that's how you're using the theta and implied volatility. And long condor spread is again using the strangle in a sense and giving it wings. So basically the strategy will have 4 legs. And in this situation, what you could do is you actually have a zone. So again, we are marrying volatility and theta. The last but not least is that instead of having just pure calendar spread, now we introduce the element of a little volatility. It's called diagonal calendar spread, but some people call it the poor man's covered call. So remember, with the covered call, you have the underlying asset and you just sell a call against it. But if you don't have the capital or you don't have those stocks, you go buy a call, a long-term call, and you just keep selling options for that call, a short-term option. So that's why it's called poor man's call. So let's say if you want to do Apple and it's like at 170, 75, in order to do that, the minimum you can do is like 100 shares to sell just one call. So you have to have a capital of at least 17,500. So instead of doing that, you can go and buy like a 9-month call. Some people even do leaps, go up 12 months. So perhaps instead of $775, maybe it's $20. So you have the leverage of, let's say it's 9-to-1. And you buy that and start selling short-term, let's say monthly, you could even do weekly, but let's say monthly against that call. So again, that's in a nutshell. I just want to give you really a juice of the whole strategies that maybe it's a refresher course, so you just remember, some of the opportunities you have. I didn't talk about broken wing butterflies. You're not talking about back ratio spreads and all that. We have the Christmas lice, lizard, and these are the main ones. So that's why we want to focus on these. And once you understand how to sell an option, everything else comes into the picture. And that's the difficult part that a lot of people have difficulty. And that's why like 90% of option players, they just buy long call. They just buy a call and hoping that things are gonna go their way, let's say go up, or they buy put, and sometimes for hedging reasons, and that's what they're hoping it will happen. So I mentioned about the expected move and the implied volatility. This is Apple from today, for instance. This is what you want to pay attention. So if you want to do the strategy, you look at, again, Apple has the weekly and then monthly, and you can see based on that, what implied volatility, if it's pretty high in the future, is it maybe again, been like for S&P, for instance, today we had the CPI numbers. So implied volatility for this week was high, but next week we don't have a major news coming up. The same thing with Apple or other big stocks. When they have earnings, you see that implied volatility goes up tremendously and then it comes down. So that's the strategy, use the implied volatility. This is one of the ways you can use that. The other thing you could use, and I just mentioned about at the money, you can see in this situation, Apple is a little under 175. So the delta, it gives you the probability of either going up or down, and it's at 49. So it's about 50-50, as I mentioned. So one of the things is you can see the put is at 46 because it's in the money right now. So it's about 50-50. And I mentioned about the implied volatility. As you can see, when we go way in the money, for instance, look at Apple at 60 and 65. Well, there's not much going on, but at, let's say, 60 and 70, look at the implied volatility where compared to where it is right now. The same thing on the put side. You see the put side implied volatility goes way out. So that's, again, when we look at the delta, you can see, for instance, the chances of, in this situation, for instance, the chances of Apple, and this is June 16th, that's a monthly expiration, of reaching $215, the delta is actually 0, or there's a 99.7% chance that the market thinks it's not going to reach out there. And in this situation, that's what the valuation is, like 1 penny. So they haven't, because they feel that there is no chance. So that's how the valuation is. But sometimes we can take advantage of that if there is a high probability that it's not going to get there, but there's a juicy premium. For instance, if I look at the delta 20, for instance, and under, if you have something like that, then that's would be right around here. You can see the deltas are like 166. It's interesting that we have some values here. There's a 70 and say 84% chance it's not going to reach there. So that's how you could use that. But I just want to show you the example I gave you out of the money and in the money, way in the money, they have the highest implied volatility. And most of you are familiar with this expected move. And this expected move basically comes from this. So on a weekly basis, we do it on Friday after the markets close. So we can see 68% of the time, Apple is supposed to stay within these zones, which has been respecting that. And that's how you can build your strategy. So at the end, as I said, I wanted to do it like it's 30 minutes and under. It's putting it all together. So the way you want to look at your strategies, first of all, you want to have some kind of idea what is happening with your underlying security, or is the markets. Is there any trend? If there's a trend, is it up or is it down, or is it sideways, like really choppy, or that you have no clue? So basically write these down, so accordingly you can make a strategy. For instance, if it's going up, would you like to do for instance, you just want to buy a call, or you want to do a debit call spread, and or you can even do a higher up butterfly if you like. And then you got to decide, if that is the case, how long you want to hold it, when is it going to meet your objective, if that's the case. And again, we can use the squeeze, you can do linear regression channels. So you have the tools. And basically, if there was a breakout, you're using technical analysis. and how long you want to do it. You want to do it weekly, you want to have it for a month, you want to do it for 3 months. So that's other thing you have to decide. And how much risk are you willing to take? Is it a low risk, medium risk? How much capital do you have? High risk? And based on that, you can say, all right, basically, if I want to take a really low risk, maybe instead of just buying a call spread, maybe I can do a debit call spread once I do verticals. And the last but not least is, what is your objective? Do you want to have income? And if that's the case, then you go with a high probability. And that's where you could do covered call if you want, or you can do the credit, vertical credit spread. So you can do credit call spread or credit put spread. Or is this a hedge? Do you want to have a put secured, a secured put strategy? You want to protect your portfolio, or basically you want to just buy a put options, or you want to do a debit puts, so vertical spread. So basically on that, or is it speculative? And it's a speculative, really, when you go binary, you just buy a call, then you basically, it's a 50-50 in many ways. So even less actually, because you're really not taking into account that the premium you're paying for those options and the volatility and how the prices could move. And the last but not least is the growth. Is this, you want to have something that is gonna give you, again, the potential for upper mobility. In this case, let's say a higher rate of return. And we talked about, again, debit spreads, which they allow you to actually participate in the move, but don't put as much risk or put capital towards that. So these are the things I want to pay attention. So I hope it was helpful. Again, I just want to give you, in a very short term, this was more of a review. If you want to look at all those strategies, again, we have the videos especially built for them, but just a refresher. And as I said, you can also refer to our July, a couple of years ago, I think I did that, and that could be maybe a good refresher for you as well. With that in mind, I hope it was informative, and hopefully maybe it reminded you of some of the things that you have access to. So I'm gonna go ahead and stop the recording and open up for Q&A.